In this video, traders, I want to give you an example of a hit and run trade. Stay tuned. Hey guys, warm welcome to you. All right, so I want to give you an example of what I call a hit and run trade. And a hit and run trade to me is a very kind of higher probability trade. You sacrifice risk reward ratio. In other words, you're not kind of looking for 3-to-1, 5-to-1 plus. You're looking for one quick move, and that could be 1-to-1. It's just the probability is assumed to be high. Of course, we never know this, and we can't put an actual judgment on it. But over time, you kind of see some things and go, hey, there's a good chance this does this. Now, a hit and run to me is an A to B type trade. It moves from one point to the next point. You're not looking for any runner. Now, sometimes they run on, sometimes they don't, but the theory is it's a scalp type trade. When I say it's a scalp, it might have a reasonable duration in time, but it's more of a higher probability move than something that, hey, it's got a 5-to-1, it's got a 10-to-1, but chances are pretty slim of it doing it. But it doesn't matter, because if I take these all the time, then and I get a 10-to-1, it's going to more than outweigh the times it doesn't work. Of course, the best possible scenario is the ones we've got high probability of success, or perceived high probability of success, say that quickly, and a decent risk reward ratio. Okay, so as usual, these things, guys, these are recommendations or anything like that. It's just something to share with you that maybe you can go out and look at the charts yourself and give you kind of some ideas and stuff to start your own research and come up with your own ideas and strategies to approach this interesting game. All right, so I've got on the screen here the DOW ETF. So it's DIA, which is the ETF of the Dow. So it's effectively mirroring the price of the Dow futures, YM, a Dow CFD if you trade CFD, US 30, or a spread bet if you're trading with Pepperstone or any of the providers. That's going to be exactly the same pattern, but the reason I use the ETF, just like I would use the Qs for NASDAQ, OQQQ, and I would use SPY for S&P, is that I can easily see on TradingView here the gaps. And I like to see that. It's something, maybe it's just because of the way that I've always traded. I like to see the gaps. I will obviously look at the 24-hour chart, and I will actually obviously look at the product I'm trading and the chart I'm trading. So if I'm trading the YM futures, I'm going to see that. If I'm trading via a spread bet, I'm going to see that. But I just like to visualize this, and it helps as well for this video to kind of see where we are in the bigger picture and see the gaps and stuff, especially at the moment we've got such big gaps. All right, so scenario. Market's gap lower, and so we're weak, right? We are at a weak scenario. I'm just going to mark off that low, by the way, so we can see that when we zoom in on this. Now, I'm still in mean reversion mode, and we're like, whoa, hang on a second, we've gap lower in this, and it's context, okay? If the pattern was more like this, red, 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 with a tiny little bit of green, I'm not going to just be stepping in front of that. I don't want to do that. But as we've got these, what I call mixed candles or dirty candles, red, green, 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 red, red, there's no real direction one way or another. It's oscillating back and forth, back and forth, back and forth, right? And even when we start to try to push to the downside, it's not really picking up steam. There's still some green, there's still some red, there's still some, it's two-way flow. And so because of that, I am still looking, even though, if you looked on paper, you'd be like, whoa, it's at lows, it's this and that and the other. Why would you buy it? Because of the context. I did a webinar actually a while ago for Pepperstone talking about reversals specifically. And one of the things that I talked about was, hey, for me, it's about the context of the move. If the market's ramping up to a level, then and it's got a real steepness and aggression to it, then I need to see either exhaustion or a pullback and retest. I'm not just going to step on the first tag of a level. Whereas if it's grinding up there and it's a bit mixed and it's like a shallow trend, just like this, I'm going to be okay with looking for that mean reversion. And another thing at the moment, and always do your own homework on this, is that very often we kind of see these reversals and swing points around European close. It comes on and off, actually. We've had phases where it's been quite regular, and then phases where it kind of phases out a little bit or fizzles out a little bit. So European close 4:30 my time is when everything shuts in the UK, or the bell goes, shall I say, for the FTSE on the DAX, and sometimes the market in the US gets a new lease of life. And so that's something that I'm looking at quite a lot. So anyway, let's go back to the context of this trade and why is it hit and run trade. Market's choppy, fine. We are trading through the low. We have gap lower. Yes, that doesn't have that going for it, but the context is okay still. And we have the VWAP's been a magnet. So the white line here is the VWAP, volume weighted average price. It's sucked price back in multiple times. Look how many times we've crossed it. It's not like we've ripped off and we haven't touched VWAP at all. After this, we've pulled away, pulled away, pulled away. So let's go back to the concept of this trade. I'm trading this mean reversion trade, and I think back to VWAP's a reasonably good idea. And VWAP's pretty much aligned with the prior day's low as well. And we haven't really we're not got a cascade of stops. You know, sometimes if you go through a prior day's low, it's just one-way street, bang, 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 everyone's selling cascade. It's not that way. It's two-way trade still, even though the trend is lower. So even though you could draw a downtrend line and say, yeah, you know what, we're pushing lower here, we're grinding lower. It's not that steep. It's still oscillating in a channel. Quite easily come back up and retest that opening print, retest that VWAP, retest the prior low. And that's my thesis. So anyway, we start to see this big wick to the downside, a big tail at the European close almost on the dot. And then some perked up a little bit. But saying that, I'm not that excited yet. Don't forget, we can't hindsight this too much because we've had a lot of wicks and tails and all sorts of stuff. And, you know, very often they're just going to get chomped through. Like that was okay, but then it gets chomped through. But that's decent. So I'm reasonably alert to that. But this is more exciting. This candle here, to me, is far more of an exciting candle. Let's use that one there. That's far more exciting to me because I like to look at the range of the candle and normally you can visualize this by eyeball, but for the purpose of this video I put a 1 period ATR in here so you can just see the range. And the range of this candle is, and that's not a great color, is it, for black? Why have I done that? Let's put it on yellow. There we go. You can see that more clearly now. That's the range. So it's the highest range green candle that we've had for a while. Decent one there. This one's solid and it's off the low. You know, so it's okay. I mean, it's not perfect. It's not as nice as this candle here, if that had been solid, but it's okay. And it's the time's right, and it's broken through this little mini trend line. Not that I'd put too much weight on that. And it feels like the VWAP's just sucking price back in. So I'm going to take a long, right? I want to take a long. And a valid question you might be saying is, well, why don't you take the long on that on the little wick? Why don't you take a long on that little hammer? And that is valid. And I think, well, I know that if we're in a uptrend, the environment was different, you want to be a little bit more aggressive. You want to be taking it on those little wicks because you know that very often they're going to hold and it's going to do another leg. So if it's a pullback to the downside after a big strong uptrend, starts to come back, forms that shape, you can be a bit more aggressive. Whereas when we're now in technically a bear market and with gap lower and there's a lot of weakness about, I don't want to be, you know, being that aggressive. I want someone else to pioneer lifting those offers. I think that's got a little bit of legs. I'll jump on it, grab what I want and run off. You know, I'm not going to try to be a hero in this environment because we are still in a weak environment. The market's lower. It's gap lower. We're below prior day's low. We're on a downtrend on the daily. There's lots of negative news out there. You might think it doesn't have relevance on the 5-minute chart, but it absolutely does, because if that was flipped the other way, then you're going to get the rising tide and it can allow you for a little bit of an error in trade. So yes, you do give up risk reward ratio or target width, if you want to put it another way, but I think you turn the probability up in your favor, which you need when you're trading counter trend in the broad trend. That's just my opinion on things. So we see this, and then the next candle, like, okay, I'm going to get long if we take a break of this high. I'm just going to, that's what I'd like to do on this. And so we started to kind of oscillate around a little bit. I got long. I'm managing this trade. I'd sat through this pullback a little bit before I took the trade. It came down, pushed back up, and I see it holding. Now, if we were being objective and you were being absolutely binary about this, you might say that's too low. That little pullback there, you might say that's too, let's get rid of that. You might say this little pullback's too low. And I would agree with you. I'd be like, okay, but when you're watching tape and you're watching stuff, sometimes if it's just a little kiss lower, pop back up, just a little sweep of bids, pop back up, you look at it differently. Is that the right thing to do? Wrong thing to do? I don't know. I don't know. I just sometimes, if I see that sweep lower and pop back up very, very quickly, I think, okay, that's probably just a one market order. If it's gone lower and it's doing some business down there, 10 seconds, 20 seconds, 30 seconds, lots of size, and then just creeps back up to get the print at the end of the 5-minute and it will still look the same, that's different. But anyway, that happens. I get long. I then say, okay, what am I going to do with this? I'm looking for VWAP. Come out if we start testing down here. I'm absolutely relying on the standard's going to be below that low there. But to be honest, if we start doing too much work down here and holding, I'm probably out anyway. I'm just not going to entertain it because the idea of its momentum, it's like an impulse bar. I want to see the response to that impulse bar as pretty positive, or at least not negative. You know, I don't want to see it just undoing all the work and coming right back to the lows here. That would be pointless. It's not the idea of the trade, it's not the thesis of the trade. And so do you want to see some strength and say, okay, well, I think we might just get a push back to VWAP. The VWAP will be strong enough of a magnet just to pull price up to it. And it did. I'm done. I didn't even hang around with the trade. So I guess that's an example of something where, you know, it's not glamorous. It's not textbook in a way, but it's just observing price and supply demand and saying, okay, well, this has a good likelihood of doing this, and if it doesn't, I'm going to cut it. And is it structured in the best possible way? No, it's not. Is it going to win any awards for the best structured trade out there? No, it's not. But sometimes these are the type of trades that just, you know, just think a couple of these a day, or, you know, might even take one or two of them a day, waiting for a broader move, waiting for a bigger trade, waiting for something that's got high probability, maybe taking a probe with the upside of the range. Maybe you want to wait for a break of the range. You know, maybe you're trading that, and this is kind of, okay, I'm still aligned with mean reversion, but I want to see something really substantial first before I jump on and be very quick and aggressive to cut it. So hit and run trades, guys, I think as long as they're categorized in a different bucket, that's okay. If you start to broaden them out, say, well, it's the same as like a big rippy flag or high type flag or a catalyst, and you're bundling all those stats together, I don't think that's the right way to do it. I think you're better off just categorizing them separately, putting them in a separate bucket and say, hey, these are a few rules for these hit and run trades, whether they're exhaustion, whether they're mean reversion, whether they're momentum, whatever they may be. Recognize they've only got a very short holding time. Sacrifice the risk reward ratio for a slight increase in probability. And, you know, there can be like a bread and butter daily trade for you. Take care, guys. See you in the next one. Keep your risk managed. Bye-bye.